revenue from the other issues. Now, to be honest, all these things were covered by a very, very short standard without any real-life examples included in them. And therefore, lots of questions remain unanswered. And the most problematic part of this, that if you look all over the world, revenue recognition was extremely changing from place to place. Therefore, one of the most important numbers became a mess. Okay, one of the most important numbers became a mess. Nobody was able to compare two companies with each other because they might have slightly different revenue recognition approaches, and at the end of the day, they were not comparable, right? Because of the slight differences. And to be honest, revenue is one of the most important number in the financial statement. I don't think that this one needs an explanation. Now, before going into the standard, there is a very important thing that I need to fix in the beginning. It will look a little bit theoretic, but in order to understand the whole revenue standard, first we need to understand what do we mean by revenue. Not according to the standard, but theoretically. Actually, at the end of the day, according to the standard and theoretically, we will end up with the same things. Now, by the way, what is profit? Well, if I ask this very, very easy question, it's very hard to answer by a definition. What do we mean by profit, right? Or what do we mean by loss? Well, there's a definition for that in the framework. Profit is nothing else but an increase in the activity which is not coming from the owner. That's obvious, right? Now, if I want to put it in a formula, how shall I formulate it? Profit is income minus expenses. Well, that was not a complicated thing to say, right? However, if we are talking about incomes, please note that incomes, once again, theoretically, can be split into three categories. Now, the income first may be a revenue, or a gain, or something else, right? Accountants are really good at having the other category, so we will always have it over there in case we can explain something that we are going to put it to others. Okay? Now, anyhow, what do we mean by revenue? Revenue is the income which is coming from your core activity, and this is extremely important to understand. No matter how IFRS 15 defines the words, this is the first thing that you need to understand, that revenue, what is generated in the ordinary course of business. Why is it very important? Revenue in the income statement must be a really, really clean number. What do I mean by clean number? You don't put anything inside there which has nothing to do with your core activity. Let me give you an example, because this one actually, to be honest, is very hard to see if you just read the revenue statement. Let's assume that my activity is to produce shoes. Okay? Now, what is going to be my revenue? Of course, the selling of shoes is going to generate me the revenue. That's pretty obvious. Now, let's assume that for some reason I purchased a type of leather. But that leather I don't like anymore, and I'm going to sell it to somebody else. Is it going to generate me a revenue if I'm selling leather to somebody else when I am a shoe manufacturer? No. The answer is going to be no. Why? Because this is not part of my core business. Therefore, we have to be really careful that revenue is only included where? It's all, in the line revenue, I'm not going to be allowed to include this type of amount. Because this is going to be what? This is going to be a gain, right? Now, what is a gain? Gain is basically an income, right, which is coming from something that I have sold, but I did not intend to sell it, right? Okay, so that's actually the biggest difference between the two. And please remember, whenever we have the issue with the revenue, we are only talking about which one? The first one. What is coming from my very core activity. And then we have the other category. The other category is obviously going to be everything else what we just cannot explain. Okay? So, this is the first thing that you need to remember before reading any of the standard that what do we mean by revenue, so what is coming from my core activity. Okay, and let's go now into the IFRS 15 revenue. Well, actually the title seems a bit odd. right? Revenue from contracts with customers. So actually, when they first started to construct this, everything was built around the contract. So you will see that, honestly, this is going to be a bit, you know, legal perspective. Now, what we are going to do, we are going to see, there's going to be a little overview. This is going to be the first thing that we are going to do. And then we are going to talk about the scope and the scope exceptions, summary of the basic steps of the model, the other aspects, and the presentation and the disclosure. So this is how we are going to organize this. Now, the standard was issued on the 28th of May 2014, and actually they have been working on this standard for a very, 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 very long time. Okay? And actually this is a joint effort of the IASB and the FASB. So basically it seems that all over the world now the revenue recognition is going to run according to the same rules. Virtually every industry is affected. How you heard it in the keynote, yes, every industry is going to be affected because everybody is going to have revenues. Now, what also you need to really, really be careful with is that this will have a huge impact on the financial statements. So before introducing this standard in real life, you need to see what needs to be changed, you need to see what considerations needs to be made. Okay, now, first let's see when are we going to start using this rule. The rule must be used starting on the 1st of January 2017. However, immediately what you need to understand that 2017 is not the year when you are going to start to work with this. Why? Because you will need comparative figures, right? And if you need comparative figures, it means at least 1 year before that, right? At least 1 year before that. You will see that the transition rules for these standards are really altered. Okay? They are not going to be easy. So probably you need to start tomorrow to work. You need to start to work on this tomorrow in order to get ready. Mostly not because it's that complicated, but you need to go over all your contract types, and this is going to take you very long. Now, early adoption for IFRS is going to be allowed. Actually, I didn't tell you that I'm working as a professor, really. But I also practicing as an auditor. And some of my clients already started to think about early adoption. To be honest, they all gave up. And the reason for that, because they concluded that the time for early adoption is not going to be enough. So what they are doing, they are trying to do the figures without actually transiting to it, right? See what are the biggest impacts going to be. And they decided that they are not going to early adopt it, but there is a reason. I mean, there is a possibility. If you like to do that, you can early adopt it. I don't think that this is going to be a very popular way of adopting IFRS 15. Now, for US GAAP, actually no early adoption for them. And they are going to start it 15 days earlier. I don't know why they want this 15 days, but they want to start it 15 days earlier. So every accounting period that starts on 15th of December or later in 2016 will be using this standard. Now, and here is the message, the first important message. This standard, the revenue recognition standard, are going to suspend the following ones. It is going to suspend, most importantly, IAS 18. So the old revenue standard is going to go away finally, right? Don't worry, we are not going to cry too much because that standard was not something what was very useful, right? So if you read the revenue recognition standard, it did not include too many rules, it wasn't detailed, and actually revenue recognition was not really something that was, supported by IFRS. So that's the first one. Also, a very old, and actually a very useful standard will be expanded, and it's going to be IAS 11, construction contract. Don't worry, the rules are not going to go away. They are just going to merge into IFRS 15. So you remember IAS 11, what is IAS 11 talking about? Construction contracts, but it was a lot more than construction contracts, right? Because this was the standard that introduced us how to deal with what? percentage of completion method, right? Now, don't worry, the percentage of completion method will stay as is. The only thing what they've done, they just simply took the rules and put it into IFRS 15 and made it a bit more detailed. Right? And there is two more things that will be going away. Actually, they will not really go away, but they are going to be built in IFRS 15. One of them is IFRIC 13, customer loyalty programs, you know, the airplane miles and the points that you can collect in the supermarket, how to deal with them. Once again, don't worry, if you know how to deal with them, nothing will actually change, just there are going to be slightly new names to it. And the last one is IFRIC 15, Agreement for Construction of Real Estate. Now, to be honest, this time, this interpretation will not be used anymore. And the reason for that, because what was the main idea behind this IFRIC 15? In IFRIC 15, we had a chart where we could decide if a sale of a real estate is under IAS 11 or it's under IAS 18, right? So that was the main idea of IFRIC 15, because we didn't know if we can use percentage of completion or not. Why am I saying that? What's the main idea behind IFRIC 15? If I'm building a real estate, I'm constructing it. When can I recognize the revenue? At the end or when I'm constructing it? Well, it depends, right? It depends. If I'm building it for somebody else, according to the specification of this other person, then it's going to be a construction contract. If I'm building it, well, on my own risk, which means that I'm trying to build a residential area, and then I will try to sell it to my buyers, then I will be able to recognize the revenue as if I were selling what? Goods. What does it mean? At the end, right? At the end. Now, why did we need IFRIC 15 then? Because there were two separate standards, and we needed to decide where to put it, right? But now, we are not going to have this problem, because they are going to merge together. So we still have to decide? Yes, we still have to decide. But they are both in the same standard, and they are addressing this issue. Right? So we don't need it anymore because there's no choice. Both of them are going to be under IFRS 15. All right? Okay. Good. So these are the replacements that this new standard is going to make. And yeah, this is funny. You know, that's the first time I ever hear about the so-called transition resource group. Actually, IASB and FASB understood that this revenue recognition standard change is so big that they actually made a task force who are responsible for the transition, and they are actually going to aid the transition. I don't know what are they going to do, but there are 90 members around the world, and they will help IASB to decide what type of step they need to make in order to have implementation. Well, that was only a small remark over here that they have this resource. Okay. Now, here is the core principle that we need to take a look at. And now, this is what you guys really need to remember. The core principle of revenue recognition is this. Recognize the revenue, to depict the transfer of promised goods or services to customer in an amount that reflects the consideration to which the entity expects to be entitled in exchange for these goods or services. Alright, so the first thing that you need to remember that there are two huge theoretical changes. Well, to be honest, it's very easy to make a theoretical change because the current standard, IAS 18, doesn't have too much theory. Okay? Now, the first theoretical change is that we need to depict the transfer of the promised goods or services to the customer. So what we need to follow, we need to see how are the goods and the services are provided, in which pattern. And this is how we should be able to recognize the revenue. So that's the first change. So they are focusing, how is my customer going to get the goods and the services, which are, and there's one more very important word over here, promised. So they are not talking about what is actually handed over. They are not talking about what is actually going to be made available. They are talking about what is promised. Once again, it's pretty much, do you need me to wear a microphone? Or can you hear me, guys, in the back? You can hear me. Anyhow, give it to me, and I will put it on. If you don't hear me, just yell, okay? They are actually going to use the pattern of the transfer, okay? They actually use the pattern of the transfer. That's the first thing. And the second thing which is going to change rapidly is you are not going to record what you actually get, but you are going to record what you are expect to be entitled. And that's very important, okay? Now, what does this mean? Because this sounds weird. Let me tell you what does this mean. In the current revenue recognition standard, every variable consideration, okay, was basically deferred until it became almost obvious that you are going to receive it, right? I mean, if there was a variable part, in most of the cases, well, except of construction contract, because there we had detailed rules, you waited until it became obvious that you will receive it. Now, this standard over here is going to be a lot more courageous, to put it that way. It will let you to include the variable consideration into your revenue a lot sooner. Now, I am not sure how is this going to impact, in general, the financial statements. But every single client of mine in our audit profession are actually saying that according to the first calculations, their revenue recognition is going to be earlier than before. Look, it's actually a bit weird, right? Because after the financial crisis, everybody expected that what is going to happen. That revenue recognition is going to be deferred, right? Well, this is not the case. However, please note that every financial instrument related income is going to be under what? Under IFRS 9. So this is not going to impact those. They're not going to impact those. But actually, they made a huge step toward what? Toward recognizing the revenue from what? From contracts with the customer, so not IFRS 9. And actually, this is going to take into consideration the variable ones as well. Okay. Now, we are going to talk about this in details. We are going to talk about this in details. I just want to scare you, right? Right in the morning, so you can wake up. Now, the scary part is this. Look. When we make the transition, there are going to be two methods available for this. Now, the first method that is going to be available is the so-called full retrospective one, and the other one is the so-called modified retrospective approach. Okay, what does this mean? Well, the full retrospective one, it's going to be pretty easy to make. What you have to do, you have to restate every contract that you are having, no matter if it's under IAS 18 or IAS 11 currently, okay? And what you do is you have to disclose all notes according to IFRS 15, which will mean that, look, you will have a cumulative catch-up just before the first comparative period. Okay, hold on for a second. How many comparative periods are we showing? When is this standard going to be applicable first? It's going to be applicable starting from 2017, right? Now, if I am only showing one comparative period, when is the cumulative catch-up going to happen? In 2015. However, if I'm showing two comparative periods, and hold on for a second. If IAS 8 applies, so I'm changing my accounting policy, what is the rule? How many comparative periods I'm showing? At least two more, which means 3 periods. So most probably, most of us will have to do a cumulative catch-up when? For the year 2014, which we are currently at, right? So this is going to be our transition, well, not 2014, but 2015 is the first year, but the catch-up will be made day before that, okay? What is a cumulative catch-up? You restate everything what you still have going on, right? You calculate the difference, and this is going to be adjusting most probably your retained earnings. Okay. Now, there is going to be a modified approach. The modified approach is requiring us not to restate our contracts. We don't have to recalculate everything. But what we do on the first day of 2017, we restate, well, not restate, that's not the correct word, we recalculate all of our contracts and we make a modification for the first day of 2017. Okay? But there is a very, very expensive price for this. Look, this is an expensive price. We have to do two sets of notes. We have to show how would the numbers be under the current rules and how much would the number be under the new rules. So actually we have to make two sets of notes, two sets of numbers, two sets of everything. Well, you can decide which one is easier for you guys. If you want to do two notes, or if you want to do two periods but not two notes. Actually, most of our clients decided that they will do the full retrospective because even though that if they don't do the full retrospective, they still have to do the restatement at the end of the day. Okay? Now, there is one thing that you need to remember. Not all the contracts needs to be restated. There is going to be a small relief that we can use. And the small relief is that if the contract was finished before 2017, then we just have to leave them as is, so we are not going to deal with them anymore, okay? We are going to talk about the transition in details, but what you need to remember that this is going to be a very, very hard job. So as I told you, if you are using the modified retrospective approach, then you need to disclose the amounts in each financial statement. Hold on. Line by line. What changed? Okay? So basically you are building a bridge between the new standard and the old standard. This is what we've done previously. This is what we are doing from now on. And that is the difference. Okay? So that is the modified approach. And you have to do two sets of notes. Right? You will need to do basically two books. Okay? You need to do two books. However, what is going to be your earnings? If you are doing the modified approach, you don't need to restate your contracts. Okay? You just have to start to use the new standard when? Starting now. Start now means 1st of January 2017. Okay? That is going to be a long year. Alright? You remember consolidation. That was a nightmare when we transited to IFRS 10. That's going to be another one, right? I have a client who is operating in the telecommunication industry. They already started to work on it, okay? And they told us that actually they don't know yet which approach are they going to choose when they are going to do the transition. Because in the telecommunication industry, for instance, every single contract of theirs is going to change, right? Of course, it's easy if you are just selling and buying things, because then there are not going to be a lot of changes. But if you have complex goods, and you will see, especially those where you have in one contract several performance obligations, whatever this performance obligation might be, we are going to understand it in a minute, then it's going to be a long, long day, long year. Now, let's see what is the scope of IFRS 15. Actually, you already have an idea what is the scope of IFRS 15, because I told you that basically everything which was under IAS 18 and everything which was under IAS 18 and IAS 11 are going to be under the scope of IFRS 15. So, here is what we need to remember. In the scope of IFRS 15, we are going to have contracts with the customers. Okay, so contracts with the customers. So everything when the contract is going to regulate my relationship with the customer, which is basically everything, And also it is going to include sale of some non-financial assets that are not an output of the entity's ordinary activities. Well, to be honest, when I first read this line in the standard, I wasn't able to understand it. But then after a long, long discussion, what the heck could this be? We arrived to the solution that this is basically all those type of things which are mainly gains. So basically, you remember I told you, income has three main parts: revenues, gains, and others. And basically, almost all the gains, so when I sold something with the view not to resell it later, are going to be under this standard. So for instance, sale of property, plant, and equipment, or any intangible assets. All right? So these are going to be included under the scope of the standard. Now, what is not in the scope? Lease. Lease is not going to be in the scope. Why? Because there is going to be a new lease standard. When is the new lease standard due? Well, it's a very hard question to answer because the lease standard should be issued already 5 years ago or something, and we are still having only exposure drafts on it. I think it's the 5th exposure draft or something, so I don't know, we have a long way to go. Also, insurance contracts, it's under IFRS 4, so nothing to do with it. And the most important thing is that one. Financial instruments and certain other contracts. Financial instruments are not under the scope of this standard. Are not under the scope of this standard. Okay? Now, let's skip the certain non-monetary. What is non-monetary exchanges? When you exchange goods for goods, right? Basically goods for goods. Some of those are going to be excluded from the standard. We are going to talk about which ones. For now, let's disregard this. And this. This is very common in this type of the verb, in this part of the verb. Certain put option on sale and repurchase agreements. Alright? What is that? When I sell something and I promise that later I am going to buy it back. Usually at what price? At a higher price. Why? Because there is nothing else but a financing facility, right? Then why am I selling you things? Because you need a security. So I sell you something and I agree with you that I will buy it back later for what? For the original selling price plus interest, right? Okay? So these things, however it looks like that I've done something which is a contract with the customer, this is going to be a financing facility. So it's going to be under which standard? IFRS 9 or IAS 39 if you still did not adopt IFRS 9. Okay? So this is the scope thing, right? Basically, I can say that the scope did not change too much from the current standard. There is only one exception. There is only one exception. We changed. What is that? Dividends. Right? Because dividends are under where? Were under IAS 18 previously. But that was a very easy rule. When do you recognize a dividend? When? The right to receive. Because some of you said pay. That's not right. Okay? When the right to receive and the AGM is voting, and they will say yes. Okay? Well, that was a really easy rule. Why did they remove it? Simply because they put it to IFRS 9, the same sentence, the same sentence. In IFRS 9, they are going to put that the dividends received now going to be the same rule when the right is established to receive is going to be in IFRS 9. Okay. Also, there are two things which are not going to be included in the standard. And this is going to be donations or contributions. Now, this one needs a little explanation. This one needs a little explanation. Do you remember what did I tell you? What is income? Income is an increase in the equity, which is not coming from who? From your owner, right? Because whatever is coming from your owner will not be under the income definition. Let me give you an example, okay? Because this example will explain you what do we mean by that. This is the entity. This is the owner, private person, to be easy. Okay, it's going to be a private person, to be easy. Keep turning things on. Okay. entity has a building, right? And the building's value, n. Let's assume that this is very close to the fair value, okay? So this is not the trick. This is going to be very close to the fair value. Now let's assume that I'm selling as an entity to my owner this building for 7. Can I do that? It's pretty weird, right? I have a building with a fair value of how much? 10 for 7. I mean, if you